Hi, Ron Harrison here from the Unlimited Success Agency, and we're a part of the Five Rings Financial family. Five Rings Financial is a financial services company with offices and agents, representatives all around the country, 6 to 7,000 people. But what Five Rings does is we're sort of like Merrill Lynch, Charles Schwab, those sorts of companies, except where they focus on rich people, the whales that sometimes people talk about in the financial services industry. We focus on middle Americans, regular people like me and you. That's one difference. The other huge difference is the way that we work with people's money. Those big companies, they're investment companies, so their number one goal is to make money for you, because if they make money for you, they make money. But the interesting thing is, if they lose money for you, they still make money typically, right? Well, we're different from them is we believe in safety first. So we always have protection in place rather than putting people's money at risk. And I like that because I can put my head on the pillow every night knowing that my family's not going to lose any money, my friends and clients aren't going to lose any money. So we're going to be going over some basic money principles. And when we talk about principles in life, principles are things that hold true no matter what happens. As an example, I'm holding this pen in my hand. If I drop it, 100% of the time, it's going to fall to the floor, right? Or my lap, wherever I'm holding it. That's because that's the principle of gravity. We can't do anything about the principle of gravity no matter how we try, right? So when we talk about our money, if you treat your money based on principles of finance, principles of mathematics, you're going to win the money game. And most of us do want to win the money game. So thank you for being here tonight. I'll take up about 40 minutes of your time, and you'll learn these principles. Then you can make better decisions about your money. So as we start working with people, we find out that most people have a problem, and that problem is the lack of education when it comes to finances. If you think about it, we're in formal school, most of us, for about 12 years, right? Kindergarten through 12th grade, 13 years or whatever. Some people go off to college and things like that. But three of the most important things we should learn in our life, we typically don't learn in school. How to be a better parent, how to stay married, and how to manage our money, right? Those three things really important. Well, I'm not going to talk about the first two, but I am a licensed expert in how to manage our money. So that's what we're going to be looking at today. So two questions people ask when they come to our sessions, or if we get on the phone or a Zoom call or something. First, the people that have money saved, how do I protect that money? That's really important when we look at our up and down stock market, right? Stock market roller coaster, especially for people who are in their 50s, approaching their 60s, and in their 60s already. You don't have time to make up for loss. So how can you protect what you've grown, whether it's in your old 401k, old IRA, savings, bank accounts, whatever? So we're going to talk about protection in this presentation, and we'll also talk about how you can save money. Many people are just starting out. So how can I start putting away money and still live, a lifestyle that I want? How can we make that happen? So we're going to cover those two topics by looking at these principles in this presentation. So first, let's get a little bit of information about money and learn about some basics, right? And basics of our financial markets. Well, here's the financial teeter-totter, if you want to call it that. Two sides to it, right? The risky side and the safe side. When we talk about the risky side, typically when we think about our stocks, and when we talk about stocks like this, talking about individual stocks, if you buy IBM, buy Microsoft, Caterpillar, or whatever it happens to be. Then there are mutual funds. And as you probably know, mutual funds are groups of stocks. Now, mutual funds are less risky because the risk is spread out amongst a bunch of different stocks, less risky than individual stocks. But there still is risk in mutual funds, right? And finally, commodities. When we talk about commodities, we're thinking about gas, oil, gold, silver, those sorts of things. Um, there are many things that people invest in, orange juice or whatever. But anyway, with commodities, those are up and down, almost like the stock market. Think about this. 2 or 3 years ago, in 2019 or so, the price of a barrel of oil was below $1. Now that didn't directly reflect the price of gasoline, but anyway, oil was below $1 a barrel. Then in 2021 and early 2022, it shot up to like $130 a barrel. And here we are at the start of 2024, and it's around $80 a barrel. That's pretty cyclical, and that's just up and down, right? So those are commodities. Now let's take a look at, and we know with commodities, you can have a lot of possibility for growth, but then a lot of risk with commodity stocks and mutual funds, right? Now let's take a look at things that are safe. Savings and CDs certainly are safe. The challenge with savings and CDs, though, is that you essentially, in most of them, you pay taxes every year on the little bit of money you gain. You get a 1099, you have to claim that on your taxes. Money market accounts. So money market accounts would be very low interest bearing accounts. They could be with your investment company or it could be with a bank. Under the mattress is the place people store away their money. I work with a lot of people who have gun safes, and I know some people who put green money bills, $100 bills maybe, or $10 bills in their safe because they want to have that real money. The challenge with that, of course, though, is they're getting no growth at all. So in a year like we had recently with 8% inflation in a year, their 100,000 in their gun safe now can only buy $92,000 worth of supplies, materials, food, rent, whatever it happens to be, right? Of products. So that's a loss. So we don't recommend under the mattress or in your freezer or anything like that. Now, those can grow very little interest. They could have zero interest, but at least your money is safe, right? And there is very little chance for growth. But you have security in your mind that nothing's going to happen to your money. Let's take a look at the history of the stock market. And what we're going to be looking at is the S&P 500. The reason we use the S&P 500 is that it is 500 companies. Walmart, Caterpillar, AAA, or 3M, Ford, all spread across our economy. The S&P 500 is the best indicator of our economy because it is so many companies. So if we look at it, 1980 to 2000, the market went up, up, up. Now, a lot of people don't realize the reason for that, or one of the main reasons, you know what it is? 1982, 83, 84, the IRS implemented 401k programs. They announced those, and a lot of companies implemented those. Well, you know what 401k is? That is your part of your paycheck being invested in the stock market. So from 83 to 2000, thousands and hundreds of thousands and millions of people really got put in the stock market, not by their own choice, but because of how they were doing their retirement now. Because what happened was companies, when they started these 401ks, pensions were here, 401ks were here, 401ks came in, companies got rid of pensions, right? And you know why companies love 401ks and the government loves 401ks? Is because the consumer, the employee, the person is at risk on the hook for the money. With pensions, companies were at risk, weren't they? And if the company couldn't pay the pension, the government had to pay the pension. Well, the 401ks, governments are off the hook, as are the companies. So that's why we now see 401ks across the industries, and very few people, about 10% of Americans, maybe 20%, even have pensions anymore. Teachers, firefighters, police officers, people like that. So the market went way, way up to 2000. Then we know what happened in 2000, 2001, 2002. 46% loss in the S&P 500 because the technology bubble burst. And the technology bubble burst because companies like Enron and WorldCom cooked the books. They lied on their taxes, essentially. So here we were, we lost thousands and thousands and thousands of dollars over the course of 2 years, and it wasn't of our volition. We did not do it. These companies made these poor decisions that affected us. So most people said, whew, I'm glad that's done. I know it's never going to happen again. And then the market started going up, right? It took all the way to 2007, so about 4 or 5 years just to get even. Would you, if I said, give me $10,000 today and 5 years from now, I'll give you $10,000 back, would that be a good investment? Probably not. It's a secure investment, right? But it's not a good investment. It's a place to put your money. So in 2007, the market goes up. People got pretty close to even at where they were in 2000. And then boom, the housing bubble. Housing bubble burst 38% in 1 year. Again, nothing that we did as people. It was big business that caused this. Mortgage companies and banks caused this. Did you know that over 1,000 banks went for government bailouts in 2009 and 2010 when they were the cause of the catastrophe, the financial catastrophe, right? The housing bubble. They got bailed out. Isn't that crazy? So now people lost all their money again. They're down to like $70,000. So in the course of 5 years, essentially, people lost nearly 40% of the money 2 times. And people now they're saying, when is this going to happen again? Man, I want to be protected from it. So what happened in '09 and 2010, 71% of money went from risk into safety. People took it from stocks into bonds, maybe even to like the income, the indexed accounts that we do that we'll talk about in a little bit. Then, of course, all the way to 2018, we had a pretty good run up on the market, little pullback in 2019, all the way to 2021, pretty good. 2022, look at that, 20% loss in the S&P 500. Now, in all these losses, not everybody lost money. Some people made money because they were in the right place in the stock market. But most of us, middle Americans, we don't know how to do all that stuff. We don't know how to manage our money in the stock market. So we let somebody else do it and they charge us fees on that, don't they? And they charge us fees even when they lose our money. Then in 2023, the market came back up from 19%. It came up, I think, to about 24% S&P 500. Now, what goes down does come up eventually, but it can typically take 2 to 3 times longer to come back than it took for it to lose. Now we're going to talk about indexed accounts. Indexed accounts are a great way to diversify your money because index accounts, they go up when the market goes up. They lock in when the market crashes. My clients never lose money in the stock market when they have an indexed account, and we'll share that in a minute. So now let's talk about how you can start saving money. So that was protecting your money, protecting it in indexed accounts. Now let's look at how you can start saving money. First thing to talk about is compound interest. Albert Einstein said that compound interest is the eighth wonder of the world, but the caveat he put on there, if you understand it, you will earn it. If you don't understand it, you're going to pay it out, right? Mostly in high interest credit cards, loans at the bank, things like that. So the rule of 72, really, really important concept. I love teaching this to everybody but young people, kids in college, because if they know the rule of 72, they're going to do better with their money, we would hope. Rule 72 says you take the interest rate you earn, divide it into 72, tells you how long it takes your money to double. As an example, if I have a savings account earning 1%, 72 years for my money to double. 2% is 36 years. We recommend you stay away from 1 and 2% interest. Now, how about 4%? We'll see that in a minute. See an example here. So these triplets, these young ladies, their grandmother was on her deathbed, and in her will, she put, hey, girls, I'll give you $5,000 each, 29 years old, put it in one investment, let it last until retirement. Retirement is 65, right? 66, right around there. So they said, okay, we'll do that. So the first sister, she did the same thing her parents did. She's found a relatively conservative investment. And as you know, if you put something in long term, you can get better interest rates than you can if you're just doing short term. So she found a long term 4%, maybe a CD or something like that. So if you think about it, 4 into 72 is 18. So every 18 years, the money's going to double. So at age 65, close to retirement age, she promised her grandmother, right? Her money has quadrupled. That's not bad for just set it and forget it. But of course, if she had in a savings account or a CD, she was paying taxes every year. Now let's take a look at the next triplet. The next girl, she was very fortunate. She came to one of our Money 101 classes, and she learned just like you that, hey, if I give it enough time, and if I don't have any losses, I can have 8% gain. on average over time. So 8% is 72, that's every 9 years. Now, I'm not a math wizard, but I know if you double the interest, you're going to double the money. So obviously, this sister's going to have $40,000, right? Let's take a look at this. So she's caught up to her other sister at age 47. Now she's doubled her sister at age 56, but she has one more compounding period, 80 grand. Is this a big difference or little difference? This is a big difference. And this is the power of compound interest. We didn't go from 4 to 12 or 4 to 16. We just went from 4 to 8. Very, very reasonable. So you need to look at the interest you're earning on something. If you can gain 1 more % interest, in the long run, that's going to be a giant pile of money, right? Now, the third sister, she did what her other sister did, but she said, hey, you know what? My parents told me at one time, like back in the 70s, you could get 12% interest. And it's true, you could get 12% interest then because mortgages were like 16%. These days, if somebody says you can average 12% or get 12% every year, walk away, walk away. There's no place you can get 12% every year unless you're doing hard money lending in real estate or something like that. But traditional plans, you're not going to get 12% every year. Now, you could get a 12% average, but if you have a 12% average, there could be years where you might have a minus 20. Nobody wants to have a minus 20 again, do they? So 12% is going to be 6 years doubling. So let's take a look at that. Check this out. 320,000. Now it's a giant, giant gap, isn't it? And we didn't go to 24%. We just went to 12%. Now, how about 18%? Who would like to have 18%? 18% would double your money every 4 years. That would be incredible, wouldn't it? Well, again, you have to understand compound interest or you're going to pay it. And many people pay 18%. That would end up being, in this scenario, 2.5 million. Credit cards, people pay 18% in credit cards. Some people paying 24% in credit cards since interest rates have gone up so much in 2022 and 2023. Stay away from those high dollar interest credit cards, right? Now let's take a look at taxable and non-taxable accounts. Most people don't necessarily like paying taxes. Taxes go for good things, right? Taxes repair our streets, taxes pay for our schools, taxes pay for our police, those sorts of things. But there are some things that our taxes pay for, whether it's state, local, or federal, that we may not agree with, but it's out of our control. Also, do you think taxes will go up later in life? Most people think taxes are going to increase 5, 10, 15 years from now. It's the way our government operates, right? We can't control it. So let's take a look at this. So first, non-taxable. This is the idea about growing your money, non-taxable, not paying taxes every year. Remember earlier I talked about savings and CDs. That's paying taxes every year, so you lose the power of compounding. So non-taxable. So this is going to be a scenario over the course of 20 years. And the way this works out, you start with $1 and it earns $1. So now you have $2 at the end of year 2, $4 at the end of year 4, $8 at the end of year 8. No taxes coming out. Now we know that you cannot there's no way you can double your money every year. Now there is a place you can double some of your money, and that is if you have a matching 401k. Let's say you get a 6% match. Get the 6% because that's $20 bills off the sidewalk every day. That is 100% return. That's a smart money move. But we recommend don't put more than the 6%, more than the match. Take some of that extra money and put it into something different, something diversified. And we'll talk about that in a bit. So in this scenario, double, double, double like that for 20 years, $1 million. Hasn't been taxed yet. We'll talk about that in a second. Now let's talk about taxable plans. So taxable plans, same dollar. In this case, though, it doubles to $2, but who comes a calling? Uncle Sam or your your state tax people, your local, your county, whatever it happens to be. They all have their hand out for you, right? Now we're just going to use a conservative 28%. Back in 2020, one of our people was doing a presentation, and somebody in California said, I already pay 45% with county, state, and federal. But we'll just use 28% because that's almost like an average for middle Americans, maybe. So if you think about this, the person made $1 in the year. Uncle Sam wants 28 cents. So that dollar subtracts down to 172. Double 172, it taxes down to 296. Double 296, it taxes down to 509. Now let's think about what this total would be. Often people say, well, I think it's going to be 700,000 because 28% is almost 30%. 30% of the 1 million over here would end up being 700,000 remaining. A lot of people say that. A lot of people say 250,000. Well, it's much, much less than that. Check this out. $51,000. That is the impact of taxes. Isn't that crazy? So we suggest, if you can, grow your money where it's not taxed every year. Now, a lot of you might be saying, well, how about this? How about paying taxes on the $1 million? You still have to pay taxes if you earn money, right? Hey, let's say that that's going to be a 50% tax rate. There's still 500,000 compared to 51,000, 10 times the money. So we encourage people to grow money in non-taxable plans. How about this situation? How about if you could grow money in a non-taxable plan, get the full power of compound interest, and when you take it out, you never pay a penny in taxes? How would that be? Well, we can do that with some of the index plans we have. So we've been conditioned since the early 80s to stay within the IRS umbrella, I call it, of retirement money and growing our money. Traditional IRA, 401k, things like that. Uncle Sam loves those things because Uncle Sam is going to collect tax money later in life when taxes are higher. So your money goes in pre-taxed and you pay when you retire. Well, when you retire, you probably have less income. You might have your money targeted at other things, and Uncle Sam's going to come and take 40% of your money every year, or even 30% of your money every year. Who wants to have that? I hope nobody wants to have that. So we want you to grow your money non-taxable. That way, when you take it out, you get free money, never pay a tax again. And now let's talk about how to protect the money that you already have. Now we're going to talk about indexed accounts. Indexed accounts is you participate in the stock market passively, meaning you get some growth from the market, but you're protected from the bottom side. So I'll often talk about this in the way of gambling. So in the game of blackjack or 21, there are three things that can happen in any given hand. One, you could win. One, you could lose. Number three, you could draw. You could have a push with the dealer. If you were a blackjack player like that, which one of those three things, lose, push, or win, would you get rid of? Well, most people would get rid of lose, right? How long would you play blackjack or 21 if all you could do was either win or push? I guarantee you would play it every minute of the day until you had $10 million, right? Because you could never lose a penny of what you put in nor what you grew. Well, that's how index plans work. So the indexed account, they're funded from rollovers. We do those with lots of people. They want to get their money out of the 401ks that have fees and other charges. So we roll them over into IRAs. You can put lump sum. People with inheritances, they put money in index accounts with lump sum money. Monthly deposits. Monthly deposits work out really well. My wife and I, we have 3 grandchildren, and we do monthly deposits rather than a savings account. We do them into $1 million baby indexed accounts for our grandchildren. So the money is like goes into a safe, and then it grows and never gets taxed on these sort of indexed accounts as it grows. So let's think about how the math works. So let's say the stock market goes up 8% in a year. Well, the stock market goes up 8%. You're safe. Your safe money indexed account gets 8%. Now let's say the stock market goes down 8% the next year. Is that possible? Easily possible, right? So if it goes down 8%, what do the index plans get? Index plans get 0 that year. 0 is your hero every 3 out of 10 years. So you see where you are now? The stock market plan would now be essentially where it was before, pretty even. Index plans would be 8% above where they were before. Now, here's why it's not too good to be true. Say the stock market goes up 13%. But index plans, because you have that bottom safety, right? You have that area you can never go below 0. You have to give some up on the top side. So in this case, this might be a 10% cap on the top. So many of our clients are more than happy to give up 3% to never have minus 20. So our index accounts might only get plus 10%. But you can see the index plans have grown 18% in this 3-year period. The stock-based plans have grown just 13% in that period. And if we did actual values, it would even be more of a difference there. So that is how index plans work. Now let's look at the real history of the stock market versus index plan. So what we're going to do is look at, this is the stock market. See the stock market from 2000, and let's say you start off with $100,000 in that plan. And look at how it grew over time. Look right here in 2021, end of 2021, it had a little bit more than tripled. Then 22, look at that loss, 19% loss. Do you imagine right here losing $63,000 in 1 year? Then, of course, in 2023, it made up some money, so it made up for loss. Now, a lot of times the stockbroker type people, they'll say, oh, yeah, you're gaining money in these times right here. No, you're not really gaining money. You're making up for loss. That's not a gain, is it? Now let's put on top of this, let's put index accounts. So take a look at index accounts. In the first couple years here, market dropped, so index accounts stayed at 0, the green line. Cool thing about index accounts, you don't have to wait for the market to catch up to you. You start taking off immediately when the market starts crediting. So look, the index accounts are growing just like the market was growing. 07 to 08, index accounts stayed level at maybe 150,000, 180,000, whatever it was. Then it started going up again. Index accounts, you can see in 2018, all the way to 2021. 2021, the market, or 2022, the stock market lost, but index accounts stayed at 358,000. Is that a big difference or little difference? 261 to 358. Giant difference, right? Almost $100,000, almost 25%. Now we saw that this market gained a lot of money in 2023. Index accounts gained a lot of money too. Look at that, 394,000. So there, my friends, is how index accounts compared to the stock market. And these index accounts were capped at, actually this is capped at 8% as opposed to the 10%. Now the other thing to think about here, no fees on the indexed accounts. If we took fees out of the stock market line right there, that 329 would probably be around 250, 270 maybe at the most. When you take fees out, of course, your value drops, right? Now, building your foundation, all this stuff about money is really great, but you can grow your money. But sometimes in life, we have bad things happen, particularly medical type things. Heart attack, stroke, cancer, bad diagnosis, major head injury from an accident, workplace accident, or automobile accident. Well, we believe in protecting yourself first, because when you protect yourself, that also protects your money, also protects you earning an income. So let's take a look at this. Most people in their lives, they're going along like this. The family's income is up here. Then when the bad thing happens, and expenses are down here, and the bad thing happens, what happens? Income goes down, expenses go up. We all have seen this happen, maybe our immediate family or people we know, right? We've seen this thing happen. That red circle, I call that the red circle of debt, because we're not earning money anymore, but our expenses have gone up because of hospital care, uncovered health care when we have heart attack, stroke, cancer, ALS. And we're seeing more and more heart attack and other major issues with younger people. I have no idea what's going on. I certainly hope it's not something that's going to keep going as a trend, but it's crazy what we see in the news, what happens to people. But anyway, many of you have seen this happen to folks, and when these things happen, first thing they do is they reach into their savings account. Second thing they do is they reach into their retirement account if they have one. Of course, Uncle Sam doesn't care if you have what reason you took money from the retirement account, so they're going to charge you taxes and possibly a penalty. So avoiding that is really important, because even though you're laid up and can't go to work, Insurance payments don't stop. Car payments don't stop. Mortgage payment doesn't stop. Savings for your kids for college doesn't stop. So what we do for people is we bring on something called living benefits. Living benefits, most important thing that we do. What living benefits does is it gives you a major medical um, reserve fund. That's what I often call it, major medical reserve fund. Could you imagine having two or $300,000 just sitting there waiting for you to reach in and grab it to use for your own use? That's what living benefits does. Living benefits puts a foundation under your house of assets. Living foundation is kind of the rock. If there's a story in the Bible, building your house on sand or building your house on rock, the house on sand washes away, vanishes. The house on rock survives, right? So when we think about living benefits, here's an example. Here's if somebody has $1 million reserve fund. And I did this for recently for a young couple in the early 30s. They had 3 children. They each got $500,000 in living benefits reserve, combined for $1 million, less than $80 a month total for that couple. It was amazing. They were so surprised. They were shocked. So the first thing that this covers is terminal illness. So if your doctor says that you have uh, 2 years or less to live, you can reach in this plan for up to 90% of that $100,000 reserve. Can $900,000 make a difference to a family? Definitely it can. The next thing is that it's all tax-free. Use it for whatever you want. The check shows up in your own checking account. The hospital doesn't know about it. Nobody knows about it. It's your private money from the living benefits company, and you never have to pay it back. The next one is critical illness or injury. This would be like major head trauma, heart attack, stroke, cancer, burns in a fire, amputation, blindness, uh, cognitive impairment, many things. In this case, 75%, I think it's 80% now. One of our companies, I think it's gone up. But anyway, could that make a difference in a family's life? You bet it can. Chronic illness. Chronic illness, I kind of liken it to long-term care or disability. So chronic illness, if you cannot do 2 of the 6 activities of daily living, like today, you you fed yourself, you shower, shave, those sorts of things. You transported yourself to work, hygiene needs, those types of things. So there's 6 activities like that. If you can't do those, you can get 2% per month. In this case, that's $20,000 a month tax free. That's far more money than 90% of Americans make, isn't it? So that's incredible. You just use it for whatever you want. So really an important piece of protection for families' finances. Finally, it works just like an old-fashioned death insurance policy. The worst thing happens, $1 million in your checking account, your family's checking account. Living benefits helps a family's dreams come true when something happens to the main breadwinner. That's bottom line. Now, you're 10 times more likely to have these 3 things in the middle than death like that. 10 times more likely. So wouldn't it be good to have something that protects that covers that? How to get started. We often visit people, they say, Ron, I don't have very much money to do this. What can we do? Say, well, let's do a funnel. So what we do is we look at their finances, the debt they have, their savings account, mortgage account, all these things. Tax returns a big one. And we put it through a funnel, and we often find from $300 to $500 that people are misspending. And let's just use tax returns as an example. So a person gets $3,000 a year back on their taxes, the Uncle Sam loan, right, or whatever, Uncle Sam savings account, if you call it that. So I'll say, how about this? Would you be happy if you got $1,000 this year? Oh yeah, I'd be happy. Okay, let's change your withholdings so that then you have an extra 2,000 that you can put into an index plan. Then they have that retirement going, no more money out of their pocket. They're still getting $1,000 to go to Disney World or run off to Vegas or whatever they want to do with that when they get the money in April. So there are ways that we can help people realize that they have $300 to $500 a month that they maybe have been misspending. No more money out of pocket. So You can get more details. Talk to the person that invited you to watch this, and invite somebody next to watch this, whether it's a live presentation or a Money 101 online like this. Invite someone else to watch. Sometimes we have parents who have, their kids are in college and say, hey, you're coming to this Money 101 because I don't want to support you after you get your first job out of college. Or we have people whose parents are getting into retirement age and they say, hey, I want you to come to this, learn about what you can do with your retirement money so you don't have to move in with us when you get to be 69 or 70 years old. So there are many reasons for people to come to these events, and you can come again and watch this again because I guarantee it, next time you watch this or attend it, you're going to see something new. Even though it's all the same information, something is going to click with you because you're a different person at that time. So here's a little bit of information. Since we're virtual, here's a survey you can do. So there's the web address for the survey, also the QR code. And when you complete that survey, it'll take you about a minute to complete the survey. If you're in a live situation, we'd be passing out the survey document. But you complete that survey. One of the questions asks who invited you. Please put that person's name down. If you just found it online, then just put online or Facebook or whatever. But we want to make sure that we connect you with the person who invited you to this event. So thank you very much for attending. We hope that you learned some principles that can help you later in life, help you with your finances, because our goal is to help you win the money game, and basing your finances on principles of money will help you win the money game. So take care, and may all of your street lights be green.